the internet has brought a very small world much closer together. So among that is the exchange of information, which really is just what college is. So,
everyone, and welcome into crushthestreet.com. We got an industry expert today, a man who has a pulse on the economy, understands what's going on, and is helping people right now with their financial future. His name is Benjamin J. Brandt. He is a CFP, Investment Advisor Representative for Capital City Wealth Management. His website is retirementstartstoday.com. Benjamin, thanks for coming on the line with me today.
Hey, I'm happy to be here. Thanks for having me.
Okay, so I've done a lot of research on college and just what's going on with the education system. And attendance right now is actually peaking. You know, it peaked a few years ago, and so it's declining. And this is in a time when the cost of information is collapsing, while traditional colleges are at record prices. We have the internet where we can get free information and do things like we're doing now and learn anything almost instantly. And yet college prices are astronomically high. We have 1.4 trillion in student debt and climbing. This is a number that exceeds credit card and auto loans and has quintupled since 2003. So I want to just start you off here. What do you see as the future for education and really like financial independence? How are people going to really tackle the new economy, especially just as things are changing so dramatically?
Well, I think you're exactly right that the internet has brought a very small world much closer together. So among that is the exchange of information, which really is just what college is. So college isn't obsolete yet, but I think formalized education will become obsolete over the next, few decades. I saw a statistic recently that college textbooks are as expensive as they've ever been and have actually outpaced tuition in their price increases. And I found it funny that something that is near obsolete, a textbook, is as expensive as it's ever been. So I can't think of any other object that is as obsolete as it is expensive. So just to give you an idea.
What a disconnect, right? Yeah.
What's that?
I just jumped in right there. Sorry. I was just saying what a disconnect from the free market. And it's so sustained by such artificial props. And I mean, I'm a big free market libertarian, and I just see these things and I'm blown away that this stuff is allowed to happen, and that the system is just not being overhauled yet. And I hope it happens sooner rather than later, quite honestly.
Well, it's something that couldn't exist in a true free market, right? I mean, there are outside influences that are pulling some of those levers. But to your original question, when people ask me what I do, I say I teach people how to retire. So there are, if you were just to Google how to retire, there would probably be 25 million blog posts and articles about investing and financial planning and things like that. So I really think, talking about the exchange of information, you could teach yourself how to retire just by reading blog posts and things like that. So we want to be approaching financial planning from the heart of a teacher and teach people how to do it for free, and a certain percentage of the population will reach out to us as clients, and that's how we plan on growing our firm.
Awesome. Well, if you wouldn't mind, please start off by telling us your story. How'd you get involved with helping people and passionate about doing what you do?
So I think my path to financial planning is almost a cliche at this point. I delivered pizzas in high school, and my buddy's neighbor was a National Guard recruiter. So I joined the military to learn how to clear minefields, and then right after that, I was a financial planner. So, I mean, that's pretty standard fare, I think.
Yeah. Well, let's talk then about how you're taking off and how you're helping people now, helping people to retire. And I found it interesting, and going back to the college situation, the over 60 age group now has $67 billion in student debt as of January 2017. And what's interesting is that's up from just $8 billion in 2005. And of course, we all know what happened in between those years. We had the '08 crisis. You have all these people in their late working years without a job going back to school in a time where school was just overly expensive. They were hit hard by the '08 crisis, and now they're taking on massive amounts of debt. So, what are some of the biggest challenges you are seeing people face here in 2017, especially those who are trying to retire?
The biggest challenge that I see are people are flying without any kind of a game plan. We call it investing naked. The most people that I come across are people that are investing in their 401k every month just because they think that's what they're supposed to do. And they have a heavy stock allocation just because they think, their brother-in-law told them that was a good thing to do. And it won't take much of a market shakeup, which is, if you invest in the stock market long enough, eventually there's going to be a shakeup. We're on one of our longest periods without a shakeup now here in 2017. It's been fairly smooth sailing since '08. Of course, you're measuring from a pretty steep bottom. But I think it won't take much of a market shakeup to shake a lot of these people out of their portfolio positions just because they're investing without a written financial plan, or, like I said, as we call it, investing naked.
So what are your thoughts then on the current bull market that we've seen? That's just been nonstop really since the '08 crisis. Are you concerned about the record amount of debt that is out there, the global QE that's constantly being pumped into the system? What are some of these things that you're seeing, and where does that leave you or leave us as investors?
Well, if my personal balance sheet looked like our country's balance sheet, I would be fairly embarrassed. But the government's balance sheet doesn't have to run like our household balance sheet, and maybe that's probably obvious to anybody that's been paying attention. I'm not overly concerned about those sorts of things because, one, I don't make predictions or prognostications because whether I'm right or wrong in my predictions, our clients need to get their retirement check every month, and that's what we're responsible for, is creating a plan for them and sticking with it and then helping them to execute it. So, making prognostications isn't really something that we work on. But if the debt becomes a problem, what governments would tend to do is devalue the currency, right? And so the best way to get out in front of an inflationary scenario is through stock market growth. That tends to be the best thing to fight against inflation, is to grow your portfolio long term. So regardless of how we get there, we've got to create a plan and stick with it. So like you said, the bull market has gone on for a very long time. Could it continue for another 10 years? It absolutely could. Could the market drop out tomorrow? You're darn right it could. And you need to understand your financial plan. Trusting your financial advisor is a cop-out. That's not enough. You need to understand your written financial plan, and that's the only way that you can stick with it. Because if you're retiring today and you plan, either you or your spouse plan on living for 30 more years, you're going to see maybe a dozen market corrections and maybe 6 or 7 recessions throughout your lifetime. So market timing, jumping in and out, increasing, decreasing stock exposure, you're going to fail. Even if you get the first 2 or 3 right, that's 10 more that you're going to have to get right to get this game right. So it's all about creating a written financial plan that you can understand and stick with.
Yeah, that's a good point right there. Benjamin, let's talk then about some of the tips and things that you're giving people based on the things that you're seeing people fail at. I read one of your blog posts about purchasing a car, and what are your general thoughts on that, especially as people are in their retirement years?
So when we talk about creating a plan that you understand that you can stick with, one of the difficult things to plan for are big ticket items. So that could mean a lot of things. In this case, we're talking about a car, but that could be funding a wedding for your children. It could be helping your children with their student loans, or the biggest one is probably purchasing a car, and then a close second would be large, like once in a lifetime bucket list vacations. So there's really 3 ways that you can buy a car in retirement. None of them are terrible, but if you can plan for the more difficult option, you're going to have a better time in retirement. So the first one is to take out a loan. That's an okay option, especially with rates being as low as they are. But there's going to be either some interest rate attached to that loan, or they're going to build, you often see commercials for 0% interest. I'm not a believer in 0% interest because I know the time value of money. So my pessimistic assumption is that they're building the interest rate into the price of that car. So 1, if you take out a loan, you might actually overspend. And 2, whatever that payment is, that makes your portfolio work that much harder and likely take on that much more risk, just because your portfolio is a fixed amount, and the more money we take out, we have to ramp up return to account for that. So a loan would be option 1, not the best option. Option number 2 would be to take a lump sum out of your retirement. That can be tricky for a couple different reasons. 1, you've got a silent partner in your IRA, and that's the IRS. So if you take out 20,000, you really got to take out probably 25 or 30,000 to cover the taxes that you're going to owe. And depending upon if the market's behaving or not behaving, you could end up selling more shares than you would think, especially in a down market. So if the market's down 10%, you've got to take out 10% more of your portfolio. You've got to sell 10% more shares than you would otherwise. And depending on your personality style, you might actually delay that car purchase for an extended period of time if the market is down. So that's difficult to plan for. If you if you're like me, my car is circling the drain. If I were retired and I was going to wait for that car to die, and I wanted to take a lump sum out of my IRA, if those things didn't line up perfectly, I could end up in kind of a difficult situation that my car does finally die. I need money out of my portfolio, and the market is down. So if I'm not planning ahead, I'm really setting myself up for failure. So that's an okay way, but the best way, in my view, is to create a sinking fund. And a sinking fund is budgeting out a specific amount per month that you're taking out of your retirement portfolio well in advance of your needing it. So you would just budget how often you want a car. So I want a nice used car every 4th year of retirement. So you can go online and find a depreciation calculator for your vehicle. And let's say your vehicle is worth $25,000 today, and it'll be worth $10,000 4 years from now. So you have a $10,000 down payment. And if you want to save an additional, $12,000 per year on top of that, that would be easy to budget out. I'm going to take out $1,000 per month more than I need. And then 4 years from now, I'll have, let's see, so you've got the $10,000 for your car. You've got $48,000 that you've been saving $1,000 per month, so you've got $58,000. If you need an expensive car, if you or your spouse needs a car, the numbers in particular don't matter, but it is the planning ahead along with the depreciation of your car. Match those two things up, and you'll create for yourself a sinking fund. So in my view, that's the best way to save for any big ticket item, but especially a car, because you will have to replace your car probably 2 or 3 times in retirement, even if you're frugal. That's the best way to buy a car in retirement.
Benjamin, I'm curious. Are most people taking away from their principal when they get into retirement and they're drawing from those funds? And I guess I'm wondering from the perspective of, are you seeing people be able to live off the interest that their portfolios have gotten to? And essentially, instead of killing the cow, for instance, and eating the meat, are they able to live off the milk? And and not necessarily your specific one, but in people in general, are people doing that to a large degree? Because I feel like when I retire and I'm older, I never want to see my retirement savings shrink. My hope is that it's growing while I'm living off the income to pay my personal expenses.
You're exactly right, but that's kind of a lot to unpack. So I'll circle back to what I can recall off the top of my mind. But you're right in that in theory, you want to live off the interest so that you're not depleting your principal prematurely. But in reality, that opens you up for quite a few potential errors. So let's say you have $1 million portfolio. You could maybe find a long-term CD that would pay you 2% a year, and that's $20,000 of income. And you might look at that and say, boy, $1 million, $20,000, that's not really going to get me where I want. So maybe you find a real estate investment trust that pays you 5%. Okay, a little bit more risk. 5%, that's $50,000 on $1 million. But then you look and say, okay, you know what? There is a non-traded real estate, or there are some junk bonds, some high yield bonds. I could get 9% return. Boy, now I'm getting 90,000 on my 100,000. So as human beings, where we tend to naturally go is, where can I get the biggest bang for my buck? Looking just at the income and not looking at the underlying risk. So some of those riskier high yield investments could jeopardize your principal quite a bit. So what I would say is, think about living off the interest, but don't actually live off the interest. Live off principal. So that brings us up to a sequence of returns risk. We know that if we have a 100% stock allocation and we plan for a 7% linear rate of return, we know in reality we're never actually going to hit that exact 7% because there's going to be good years and bad years. Now, sequence of returns risk, if you want to Google sequence of returns risk, if you want to learn more about that for your listeners, that says that while over a 30-year retirement, you're going to have good markets and bad markets. And if you stick to a relatively small rate of return, something in the 4% range, you'll likely not run out of money. But if you have a sequence of bad returns early on, you would deplete, from the market and also from your withdrawals, you would deplete the portfolio to a point where it would be difficult to recover from. So we can't be in all bonds because that probably doesn't provide us with enough income early on, and it'll get eaten up by inflation. We can't go all stocks because we have sequence of returns risk. That's why we need a growth and income portfolio. We need income, we need bonds for the short term, the first 2 to 10 years of retirement, and then we need stocks for our growth, years 10 through 20, and then we need to rebalance as accordingly. So think about inflation. If you think about just spending the interest, that might work for the first several years of retirement, but if your portfolio isn't growing, that interest amount isn't growing, and it's going to get eaten alive by inflation. If you go all stocks, sequence of returns risk, if you're unlucky, it's going to eat you alive. So you need to do a bit of both, which does involve invading principal, but you're growing it on the back end, hopefully enough to make up for that. So that's a little bit complicated and a lot to unpack, but that's why you need a written financial plan to know how much should be in stocks, why that amount needs to be in stocks, how frequently you need to rebalance, and let the written financial plan be your guideline.
That's really interesting. And can you just clarify what you meant by not living off the interest, but living off the principal?
So let's go back to the example. And let's say when I first started in 2006, 2007, money markets were paying around 4 or 5% interest. And that's basically a no risk or a very little risk vehicle, right? A money market account. You might have a money market savings account and not even know that it's a money market. It's a frequent savings tool. So let's say it pays 5% on $1 million, that's $50,000 a year. If I use all of the available interest without reinvesting any dividends and use that whole $50,000, eventually that $50,000 every 17 years or so is going to be cut in half by inflation. So if I'm not growing my portfolio, if I'm using all of that 5% interest, eventually that purchasing power is going to erode. So I need to come up with some sort of a compromise where I can live off of some of the income provided from my portfolio, but then also reinvest some of that income or go for a capital gain, go for capital appreciation. And so a growth and income strategy does a bit of that. So I'm liquidating principal on the front end of my portfolio by maturing bonds or immediate annuities or whatever the current interest rate tells you to buy. And then for the back 2/3, let's say, of my portfolio, I'm buying a well-diversified, low-cost portfolio that is, international stocks, domestic stocks, large, mid, small companies, and things like that. Maybe even some intermediate of real estate or utilities or high-yield bonds, things like that. So it's all about pursuing a balanced portfolio, growth and income, spending the income side, growing the growth side, and then rebalancing as you would think would be appropriate.
Sure. Yeah, no, that's excellent thoughts right there. I guess I wasn't necessarily thinking that you'd have to spend every dime of the interest if you were, let's say you're just living off of rental income, which could be looked on as interest from your initial investment. If you're living off of some of it, but then over time reinvesting, it's kind of hard to put the little bit you get off of rental income back into real estate because it requires so much capital. But if you're able to reinvest that, then it's still growing the principal too. And I guess that's what I was wondering.
Well, actually, real estate is a great example because if you are redlining your real estate portfolio and you're taking 100% of your rent and you're putting it right in your pocket for lifestyle, eventually what's going to happen, right? Your properties are going to fall out of disrepair and you're going to lose a big portion of that capital growth. Right, the value of your house isn't going to go up over time if you're not keeping up with updates, if you're not doing maintenance, things like that. So, I mean, that's a great example. If you're really redlining maximum horsepower out of your portfolio, whether it be stocks and bonds for most retirees in their IRAs, or for property investors, if it's that rent, if you spend all of it and it's gone, eventually your capital is going to suffer because you're not keeping up with maintenance. So yeah, I think that's actually a pretty good analogy.
Right. Yeah, I mean, a repair to your HVAC system can wipe out your gains from an entire year, or the rents you would receive for an entire year, or something being vacant for 3 or 4 months really cuts into those things as well. I like real estate a lot, though.
That's also a good example of sequence of returns risk. If you have bad luck and you buy an apartment building and they need to redo the parking lot or redo the roof or redo the HVAC in year 2 before you've accumulated any nest egg, that could wipe you out. But if you've owned that property for 15 years and then you need to replace the HVAC, if you've been managing that property right and you've got a savings account or you've got equity that you can tap into, then you're going to be okay. So sequence of returns risk, applies a lot to portfolio management, but it sounds like it could also apply to other forms of investing.
Yeah, that's a good point. But similar to stocks, when I buy real estate, I'm always looking to capture value at the purchase. So I'm hoping I'm getting a deal on the front end and buying in an area that I think is going to appreciate too. So you do have that capital appreciation, hopefully. And yeah, I've had some good success doing that in the areas that I've bought. And I think that's a two-pronged strategy as well. You have the income on one side, but then also if the area is growing, hey, you got the capital appreciation as well, which is, I know, something you want to do as well in stocks.
Correct.
Benjamin, I want to give you an opportunity here to share some final words of advice, any closing thoughts. If people want to reach out and learn more about you, let them know where they would go and what they would find.
Sure. Well, if people want to learn more about me, they can check out my corporate site, retirementstartstoday.com. We have a popular podcast where we discuss the topics on the minds of the modern retiree. That's Retirement Starts Today Radio. You can find us on iTunes. If they want to check out a couple of my favorite blog posts, I created a page just for your listeners at retirementstartstodayradio.com/trends. And they can check out a brief thank you to your listeners, as well as a couple of my favorite blog posts. And they can join my newsletter if they like, and all those sorts of things. So again, my biggest takeaway for people approaching retirement is don't invest naked. You need a written financial plan that you can understand and that you can stick with.
All right, sir. Well, hey, thanks for coming on the line and sharing your knowledge with us today.
Hey, I appreciate the opportunity. Thank you so much.